Assalamualaikum and hello everyone. Welcome back to my channel. Today we are going to focus on another consolidation issue, which is relating to group consolidation. That is the fair value adjustment and recognition of non-current asset of the subsidiary on the date of acquisition. For today's session, I'm going to focus on a depreciable asset as well as a non-depreciable asset, where it will adopt depreciation method, straight line method, and for the depreciable asset, it will be depreciated based on the estimated useful life. And apart from that, we will also learn how to calculate goodwill as well as providing the consolidation journal entries on the date of acquisition. And I'm doing today is that I'm taking a final exam question, FAR300, which is an old question, which has been amended to suit the current accounting requirement of MFRS 10, IFRS 10, and MFRS 3 or IFRS 3 on consolidated financial statement and business combination. So here you have the draft financial statement of Topaz and Diamond as at 31st of December 2010. So 31st of December 2010 is actually the reporting date. So you need to be able to identify the reporting date. Then you have the information here, issued and paid up capital, preference shares. So I want you to focus on the subsidiaries column. Okay. Another one, this is the acquisition of preference shares that will be acquired from the ordinary and preference shares of Diamond. And I also would like you to focus on the 12% debenture, because we are going to see that in the additional information, these are the items that are being acquired. In this information given here, that is 2350, the investment in Diamond. And for your information, if you read the additional information at the bottom here, on 1st of January 2009, this is the date of acquisition. So the date of acquisition is 1st of January 2009. That is true for ordinary, preference, and 12% debenture. So it was the shares that were acquired were preference and ordinary shares, and the company that is the acquirer is Topaz, and the one that is the acquiree or becoming a subsidiary is Diamond. So this is the subsidiary and this is the holding company. So you can see here that it was acquired on 1st of January 2009, and earlier we have already determined that the reporting date was 31st of December 2010. So you have acquired for 2 years, which is on the date of acquisition. Only after 2 years that the consolidation is being done. Okay, so the first thing first, these are the information that are given to you, which are the retained profit and general reserve, and this is the pre-acquisition reserve, which is the reserve on the subsidiary on the date of acquisition, which is 1st of January 2009. So the figure of the reserve was 80 and 70. Next. So these are information that will be relevant for us to look at the fair value adjustment. So information regarding land and building. So you have information on land, where land has been revalued to 2.3 million, and the building has been revalued to 247,600, and that happened on the same date of acquisition for both. It happened on the same date. So on the same date. So however, as the subsidiary company itself, Diamond has not yet reflected. So in the consolidation, the fair value must be reflected in the consolidated financial statement. So you have the information on the depreciation of building. Depreciation of building, you are informed it is on straight line basis, and the remaining useful life given to you was 40 years, and this is the one as at 31st of December 2010, which is on the reporting date, or on the date you are going to prepare your consolidated statement of financial position. So last information is just telling you about how the NCI was being revalued, and it was being valued at the proportion of fair value of net asset of Diamond on the day of acquisition. So it was just being valued based on the net asset figure. So what are required here? You're asked to calculate revaluation surplus and deficit on fair value adjustment. And bear in mind, the land is not being depreciated, but the building will be depreciated. So you need to perform some calculation for depreciation as well. Some journal entries to record the depreciation that you calculated in A. Calculate the bargain purchase for the acquisition of the ordinary and preference shares and debentures, any goodwill or bargain purchase. And lastly is to prepare the consolidation journal entries to record the acquisition of 8% debenture, 12% debenture, and ordinary shares. If you go back to this part, you will be able to calculate what are the percentage being acquired. So if you look at the percentage being acquired in terms of the shares, just use this different color here. I'm using red just now. So 1.6 million. 1.6 million from 2 million ordinary shares. So here we assume the fair value is 1 ringgit. So this gives you 80%. And this is for the ordinary share capital. So we will have to calculate what is for the NCI. And of course, NCI is 20%. The next one is for the 8% preference shares. For 8% preference shares, you acquired 250,000. So for the preference shares, 8% preference shares, what was acquired by the parent was 250 divided by the number of shares, because no information on fair value. We assume it's 500,000 shares at 1 ringgit each. So this one will give you 50%, meaning that the NCI is also 50%. NCI will also be 15%. 50%. So NCI. And this is the percentage of the parent or holding. Same goes here. Next is the debenture. So for the debenture, what happened is you have 100,000 debenture, and that was out of 150,000. So 100,000 over 150. This is for the debenture. We are talking about the 12% debenture. 12% debenture. 100 over 150. So that is actually 2/3. So meaning to say that other debenture holder will have only 1/3. So other. So therefore that has been calculated. So we can proceed now looking at how do we go about answering the question. Okay. Right. So let's look at what we have here. So you are asked to calculate the revaluation surplus. So on your right side, you can see here, I have already worked out for you the calculation of revaluation surplus and deficit. So let's start with the first one, which is the depreciable, non-depreciable PPE. Non-depreciable PPE, which is the green one here. For land, the fair value on the date of acquisition, when we talk about fair value on the date of acquisition, we know that it is on 1st of January 09, and you prepare your soft pre 31st of December. The consolidation is done 31st of December 2010. So you are given the fair value of land on this date, and that was to be 2.3 million. So if you check the information here, given here, right? So therefore, what you will do is, you should know that the fair value here also the same. Why is the same? Because there are no depreciation. So the fair value here and the fair value here is the same. So if that is the case, it's easy. So that 2.3 million will be compared with the carrying value on 1st of January 2009. To get the carrying value on that date is easy as well. You just need to go and check your non-current asset, and you would see that it is 2.1 million. Why is the same as at 1st of January 2009, even though the figure here is as at 31st of December 2010? Because this is non-depreciable asset, so the carrying value equal the costs, right? So the surplus was 200,000, and remember this is a pre-acquisition reserve. So pre-acquisition asset revaluation reserve. So it should be credited to the revaluation surplus. Next is the PPE that are being depreciated. So if you look at the PPE, so let's just use a different color. Okay, this one. So the depreciable PPE. So what you need to do is, I've drawn this diagram for you. You are given here the fair value in this particular question. The fair value was on 1st of January 2009, because that was the date of acquisition, and the fair value was 747,600. So the fair value was 747,600. So that is the one that should be here. Fair value of the building is 747,600, right? So to be able to find the surplus, you need to compare fair value 747,600 with the carrying value on the same date, which is the date of acquisition, 1st of January 2009. However, you are not given that directly. What was given is the carrying value on 31st of December 2010. So what you can do is, you can still find the carrying value. How? Because you know that that has been 2 years since the date of acquisition. So what you need to do is to gross up the carrying value to 2 years earlier. 1, 2 years earlier. So if it's here 40 years, on the 31st of December 2010 for the years. So here it would be 41 years, because the earlier it would be the higher in terms of remaining useful life, and here it would be 42 years. Okay, so that is the situation that you should know. So to find the carrying value on 1st of January 2009, what you can do is, if it's here 700,000 and the remaining useful life was 40 years, you need to find back the 2 years depreciation and add back to this 700,000. To do that, take the 700,000, the carrying value, divided by the remaining useful life, 40 years, and multiply by 2 years, which is from going backward for 2 years, so that you can find what are the carrying value on 1st of January 2009. So you get 735,000, and that will give you another revaluation surplus on the date of acquisition. So now the total surplus for the asset, one for building, the other is for land, it will make up 212. Okay, the next part is you are asked to calculate calculate and also show the consolidation journal entries to record the depreciation adjustment for the building of diamond. To find the depreciation adjustment, what you need to know is that if you have a surplus, that will normally be a situation that the depreciation was undercharged, or that was actually being under-provided by the subsidiary company. Under-provided. So if the depreciation was being under-provided, so what you need to do is you need to go and increase the depreciation. To increase the depreciation means from the date of acquisition, the depreciation of the subsidiary is still based on the costs. However, when you do consolidation, the fair value of the asset must be reflected. Meaning to say that from the date of acquisition, the depreciation should have been at 747,600, right? So what you can do is, the shortcut way of doing is by taking the surplus, 12,600, surplus, this is the surplus, and the surplus is, I'm going to write for you, okay, the surplus, take the surplus and divided by the remaining useful life when on the date of acquisition, and multiply with the number of years here from the date of acquisition till the current financial year end, or the reporting date, right? So that should be what that you should do to get the correct figure. So you should be doing the adjustment for 2 years. So that's why you have 12,600 divided by 42, which is the remaining useful life on 1st of January 2009, the date of acquisition, and multiply by 2 because it has been 2 years since you acquired. So therefore, you will get 600. Alternatively, right, you can also use this calculation here is 12,600 divided by 42 times 2 years. So that one will give you 600. So this is not the calculation, right? The calculation is the one here, 12,006 divided by 42 and times 2, that will give you 600. For that is depreciation that was being under-provided. So what you need to do is you need to go and increase the depreciation, record the depreciation, or increase the depreciation. You go and debit that to the retained profit of diamond, that is an expense, so that will have been debited to the subsidiary, and that should be credited to the building directly because the building is shown at the carrying value of the building is being shown at carrying value, which is already at cost minus accumulated depreciation. Next one is to calculate goodwill. So to calculate goodwill, of course, as usual, you need to go and find out number one, this one, what is the fair value of the net asset. Sorry, this is number two actually. Find out what is the consideration transferred. So what you should do is to separate the calculation of goodwill for the ordinary shares, preference shares, and debenture. So the one that you have here is for OSC. So this should be done first, ordinary share capital. How do I know that was 2 million? It is here, investment. The total was 2.35, but that one was for the total ordinary preference and debentures in terms of the cost of investment. But we are focusing on the 2 million calculation of goodwill. I start off with goodwill for ordinary shares. So the consideration transfer was 2 million. And to find the non-controlling interest, first you need to find the ordinary shares or the net asset on the date of acquisition. So the net asset that you have, one is ordinary shares, the retained profit, which is 80,000, and 70,000, that is the general reserve. So this, and then you will include that asset revaluation reserve that you just calculated just now. That was 212,600, which is coming from building and land. So that you have 236,600, and if you total up, you will see that the non-controlling interest is 20% based on the percentage of NCI for ordinary shares, multiplied by 2.36 to 600, you get 520, and the goodwill on consolidation, this is for the ordinary shares, is 109,920. For information, you can do your own calculation for preference shares and 12% debentures if you are interested to calculate goodwill. But for your information, there is no goodwill on that acquisition of preference and debentures. So you are just going to do what is required. So now you are asked to prepare the consolidation journal entries, and when we do consolidation journal entries, you will also be able to know whether there is a goodwill or not. So I start off with the consolidation journal for the preference shares. So first, what you need to do is to cancel off the investment in preference shares. First, take the carrying value of the preference shares in subsidiary. This one, 500,000. Go cancel it off. Remember, you only leave the holding company's shares in the consolidated statement of financial position. So you go and cancel off that 500,000. You will cancel it off against the investment that you made. So the investment that you made is 250,000, giving you the remaining to be attributable to the non-controlling interest of 250,000. Since the non-controlling interest and the investment in preference shares in diamond is equal to the carrying value of the preference shares. The next one is to cancel off the 12% debenture on the date of acquisition. This is the consolidation journal entry. 12% debenture that you acquired was 100,000, and that was at 100,000. So this is this 100,000 cost of investment. It should be cancelled off against the debentures that you acquired. That was RM 100,000 as well, giving you no goodwill or premium paid to the debenture holder. So 100,000 is what you cancel off between debentures and the investment. The last entry is to do the consolidation entry for the ordinary shares, and here is to cancel off the investment in ordinary shares against the reserve on the date of acquisition and against the non-controlling interest. It is being cancelled off against the reserve or the net asset So here is the net asset actually. Net asset. Excluding goodwill. Goodwill is the asset that arise through the business combination. So that net asset, and that will give you a goodwill of 109920. So I thank you for watching. This is a consolidation tutorial example for fair value adjustment, and that is focusing on the depreciation method that use the estimated useful life, and the consolidation adjustment is done after 2 years of acquisition. I thank you for watching. I'll see you when I will see you. Have a nice day, and Assalamu alaikum.